There is a high degree of risk in trading. If you've traded for more than one day, you know that you can and will lose money. Only trade with money you can afford to lose. I appreciate you joining me, everybody. I want to talk today about diversifying your system portfolio. Okay. You want to get to the point where you're trading more than one system as quickly as you can. Because, again, as I keep saying over and over, individual trials are not as reliable as a whole numbers game universe of them. That also applies to drawdowns. You want more systems going rather than less so that they get smoothed out more, okay? But the key to all that is little to no correlation between your systems. If your systems are getting you in and out at pretty much the same places, all you're unwittingly doing is increasing your position size. All right. So just briefly about me first. Been a member of the Chicago Board of Trade for over 29 years. I became a mechanical system developer trader 30 years ago, at about the time that I applied for my membership. I was trading systems successfully, but I was hoping to augment that approach with pit trading techniques, sort of another way of diversifying and smoothing out the drawdown ride. Well, as is usually the case when you try to combine mechanical, mathematical with judgment trading, if you want to combine reactive trading with proactive trading, whatever, you tend to get the worst of both worlds, all right? And that's what happened to me. Won a total loss, met some of the most interesting people in the business world, mavericks. You know, it's a universe where your word sold is everything, as opposed to the rest of the world where you need reams of paper signed to get anything done. And these people are colorful characters. I've written several books. I wrote 4 books specifically. Some of them were interview books with some of these people and other famous luminaries. Most recent book I wrote in front of you, Beating the Financial Futures Market, came out in 2006. Primarily a collection of my personal systems. I have also relooked at those systems in the 11 years since publication, and many of those systems are continuing to hum along. I've included that study in Beating the Financial Futures Market, the 2017 Almanac. But in addition to that, I've done extensive lecturing online and otherwise, written for magazines for all the major publications, trading related. What I primarily am, though, is a research nerd. Okay, I spend most of my days in TradeStation asking what-if questions. If the market does this, what is the likelihood it's going to do that? It's all set up and execution, all hard and fast numbers. Okay, it's not like general technical trading where, you know, whether a support line has been penetrated or not can depend on how thick you drew the line, whether it was with a number 2 pencil or a 4-lane highway magic marker. In mechanical trading, 3 is low enough to buy, 4 is not. It's always cut and dry like that. Every decision, where you get long, where you get short, where you take profits, where you take losses. And that's what you want to do to take the human element out of there, because we're just not wired to trade well. All right, and I'm like the biggest example of that. Okay, but we're not going to dwell on the psychological implications of trading today, because I want to get into a unique approach to diversify your trading a bit. First, some of the classic ways you could do it: simultaneously trade different markets, especially dissimilar ones. You got systems that trade in the soybeans and the currencies, as well as the stock-related index futures. You'll probably be better off than if you're just trading in one of those sectors. You can trade in different time frames. I had success trading intraday off of daily bars, holding trades overnight, as many nights as was required, until the signal to get me out or to reverse hit. These days I'm favoring day trading more. A classic way to do that is in 5-minute bars, but you can look at 3-minute bars. You can look at 4-minute bars if you want to, venture into territory that isn't tread on too much, pathways that are kind of unique. You can combine different time frames. Some traders will insist that a signal is happening in a 30-minute bar chart as well as a 5-minute, maybe as well as a daily. This is an approach I came up with, and I've had some success with it. Just take the same system, create 2 different intraday charts. We're talking a day trading system here. The first chart should be a normal 5-minute day session chart spanning from 8:30 a.m. to 3:15 p.m. Central Time. We're talking again the mini index futures, which would encompass the mini S&P, Dow, Russell, NASDAQ, mid-cap. Is that 5 there? I think I got them all. Then construct a second chart and custom design it to start and end 1 minute earlier. So your trading day on that chart would go from 8:29 a.m. Remember, markets do trade beyond the regular day sessions. They're nearly 24 hours now, so you will get trade in that 1 minute that is occurring before the official 8:30 start. And we'll also end it 1 minute early at 3:14 p.m. So what that'll do to the intraday bars is it will, instead of every bar beginning and ending on 0s and 5s, 8:45 in the morning, 8:50, 8:55, it'll move it 1 minute up so that they will start and stop on 4s and 9s. So it'd be like 8:34, 8:39, 8:44, 8:49. Okay, so it alters the entire session, and it also alters every individual bar. Okay, and this is significant. If you've traded long enough, you know that 1 minute can make a big difference. A lot of territory can be covered in 1 minute in the S&P market. All right, so slight time differences will mean that some trades will trigger in the first window, but not the second. And some trades will occur in the second window, but not the first. Okay? This is the definition of diversity. Some trades will be stopped out in one window, but profitable in the other, and vice versa. And any profit targets could also be filled in one window, but not filled in the other. Holding times could also vary. And when you vary the holding times, then what comes after is affected too. If you're already in a long, you're not going to get a new long, for example, but on the other window, you may be. So in short, this little technique will increase diversity. So what I've done is I've set up 2 5-minute bars. In this particular system, the trades go from 8:30 in the morning and they end at noon. This is just a little detail that's irrelevant. I'm not going to give you the system. I'm just going to show you that it's the same system in both windows. Take a look here. I'm calling it Z 5-minute 3 trade, and the same system on the top one here. Z 5-minute 3 trade. This top window is just regular 5-minute bars. This is the result I get in this. It's from 2005 through the 28th of June in 2017. Just want to double check something. Okay, now, I'm sorry. The window on top is the 1 minute revised. Okay, you can see if you look at the little window that I'm creating there, you got date, and then underneath that time, 8:34, 8:39, these are the times that the bars end. And on the bottom one, you've got just the regular 9:40, 9:45, 9:50. All right, so the better net profit is on the unaltered window on the bottom here. You've got a worst drawdown of $4,580, and had you started with that amount, the ultimate $59,000 you would have made in this time frame represents an increase of 1,296%. Okay, 45% of your trades were correct. And I'll just compare it real briefly to what happens when you move it up 1 minute early. Okay, you actually get a better net profit as a percent of drawdown, also known as the return on account. That's key. That's what I optimize for. Return on account, net profit as a percent of drawdown, because that figure tells you not just what you can expect in terms of profit, but what kind of pain you had to endure in getting there. So it's relative. So just to use an example I use constantly, if you had a system that was showing $100,000 with an $80,000 profit, and you were optimizing for best net profit, compared to a system that made $40,000 with an $8,000 profit, if you were looking for best net profit, you might settle on system A, but it's vastly inferior. Why? Well, you could have traded 3 contracts on system B, done better on both ends, made $120,000 combined versus 100, with a combined 8,000 times 3 drawdown of 24,000 versus 80. So the fact that this is a little better here, and the unaltered system is a little better in terms of net profit and percent profit and all, that's kind of irrelevant. What's really relevant is it's showing you that trades are occurring differently. Okay, that's all we really care about. Because next time, in the next 5 years, they may trade off. What's the best return on account and what's the best profit per trade? This is what I want to show you. Okay, this is a yearly breakdown of the normal 5-minute, year by year, versus the 1 minute early. And what's key here is some years are going to be better than the original unaltered system, and others are going to be better on the 1 minute early. So that affects your overall results, but probably more importantly, it's affecting what occurs on a trade-by-trade basis. We all want to have a smoother ride. So, to give you an example of how this, how it's practically helped me, is they cut the Russell contract in half in December of 2016. used to be worth $10 a tick, now it's worth $5 a tick. Well, I said, great. This is how I came up with a system. I'm going to divide it and trade half on the 2 staggered 1 minutes. Okay, so I am getting a smoother ride. That's the point of it. So your takeaways: any system can be traded with 2 contracts and windows with slightly different bar entry and exit times. Some trades will be altered, perhaps dramatically. Again, that'll affect everything. Lengths of trades, which will impact trades down the road. Some won't be occurring because you'll already be in them. On the other window, they'll be getting in at maybe better levels. Windows will alternate, outperforming each other in all aspects of the performance summary, not just the net profit, but average profit per trade, return on account, percent profitability, etc. The result is an overall smoother long-term result when trading multiple contracts. Okay, so please check me out on Art Collins Trading. I have some articles, thoughts, etc., and you can always email at art@artcollinstrading.com. I will answer every email. And thank you for joining me.